So before we talk about that final risk, I just want to explore what options we have to deal with risk. So first of all, one of the things that we can do is reduce risk. We can actually take steps to reduce the risk of making mistakes in our business. So that would be better quality control processes to make sure that before we ship the products to customers, someone's tested that they work properly. That could be better contracts with your customers to make sure that it's very clear exactly what you are planning to do for your customers and that they've signed off. So there are steps we can make to actually reduce the risk of a problem going wrong with documentation or processes that reduce it. The second thing we can do is we can pass that risk to somebody else. We can transfer that risk onto another party. Now that could be, for example, your customer. So instead of saying the price of that job is £10,000 or £1 million or whatever it is, you could go to it's a cost plus basis. So the risk of price increases on material then pass to your customer. Now, they may not want that, but that's one of the options for every business in your industry, is to say, I will budget for what I believe the cost to be, how long I think it's going to take, and add on a profit margin. Or you could say, I'll charge you for the people that I use, but you pay for materials at whatever they cost. And you're moving the risk to the customer rather than you assuming that risk yourself. And of course, you've got insurance cover. So in our business, for example, we would have a professional indemnity risk that if we make a mistake, customer sues us, we would have insurance cover that protects us from the consequences of our negligent advice if that was the case. So there are different ways that you can pass the risk of the problem onto another party rather than have it all for yourself. The third thing you can do is avoid that risk. Just stop doing the risky things. If there are elements of the kind of work you do where actually if that goes horribly wrong, the consequences are business destroying, then perhaps don't do that kind of thing. So if it's not possible to manage or reduce or pass that risk to a third party, if the consequences of that risk are so great that it will be game over, then don't do that kind of stuff. Okay. Now, I've had lots of clients over the years who they have a core business that does whatever it does, and then they say it'd be great if we could do this as well. But that bit's a bit risky, it's a bit new, they're not quite sure how to do it, and therefore their choice is do something very risky, and if it goes wrong, it damages what you've already built up. So if you are concerned about that, it's a quite reasonable step to say, well, let's not do that stuff, or let's wait until we are better at it. Let's wait until we're able to pass it on to insurance companies, etc. But a reasonable step is to avoid risky things if you can't otherwise manage that risk. And then the final thing is you just accept there is a risk. You know, there is a risk in most businesses that you might get 3, 4, 5% a year of bad debts. The only way to avoid bad debts is to work only with absolutely cast iron guaranteed blue chip companies, if they even exist these days, and to turn away all the ones where you go, okay, they're a little bit dodgy, that company, we've got to be careful how we get paid. So you can go ahead and accept that we are going to have bad debts on a small percentage of the work we do, and we've got to make enough money in the other places to absorb that cost of doing business. Does that make sense? So those are really the 4 options that you've got in your business. Is, can I reduce the risk with systems and controls and processes? Can I transfer the risk to my customers, to a third-party consultant, to an insurance company? Can I avoid the risk? If I can't do any of the other things, just stop doing the stuff that's too risky. As I said right to the start, you've got to do risky things. That's the way to make money and do business. But if it's too risky, if the consequences of the problem are catastrophic, then maybe you shouldn't be doing that. And then finally, okay, there is a risk of being in business. We accept it. We're going to do it anyway. And if it goes wrong, we'll manage the consequences because it's an affordable level of risk. So let's talk about financial risk. As the name suggests, it's all about the money. That's what we're trying to start with. Let's talk about some of the basic principles of financial risk. The top line of your business, your income, your sales line, then there are issues about, do I need to fix pricing when costs move? Am I taking a risk that my sales price is not high enough if my costs change along the way? There's a financial risk in collecting debts. It's all very well doing the work, raising the invoices. Am I confident I'm going to get paid? How do I manage the financial risk of not being paid? So, for example, you can get insurance for bad debts. It's comparatively expensive. It would depend on the people you're doing business with. But I had many years ago a client who did an awful lot of business with Woolworths when they existed. If you're all, I think you're all old enough to remember Woolworths. But they had bad debt insurance. So when Woolworths went belly up, they got paid by the insurance company. So they were happy to trade with them, even though there were some concerns because they had that protection. But for you, financial risk of getting paid is a real risk to be managed. And then, of course, there's a financial risk to your sales of being late with work, not doing it to the right standard, the right people on the job, etc., etc. So there's a financial risk to not doing the job to the standard you want to, but you lose future income because you don't do the job properly today. Let's talk about materials. You know, there's a risk of paying too much. The market's gone a bit crazy. There is a risk of holding too much stock. You know, you've got a lot of money sat on the shelf. And again, I have this conversation with clients all the time where they go, we've got, you know, £500,000 worth of stock on the shelves. And you go, no, you haven't. You've got £400,000 worth of stock on the shelves and £100,000 worth of rubbish you just haven't identified yet. There is a problem of stock holding if it's too high, but equally, there is a problem of too low a stock because I haven't got what is needed when it's needed. Tightening of credit terms, you might find your suppliers getting tougher and tougher and tougher with you on payment terms, limiting your account where they might not have done in the past. So actually, financially, managing the materials in, the materials out may become more challenging for you going forwards. And then, of course, there's cash. We all need cash. I'll talk about it in a second. But we find lots of people in the last 5 to 10 years who've had cash have gone, well, we'll buy that digger out of cash. It's 80,000 quid that we've got the cash. I've seen people buy property with cash because they've had enough cash. But once that cash is locked into that asset, it isn't so easy to refinance it when you suddenly need a bit of spare cash at the end of the month. And what is evident now, and we'll see it getting worse in the next 3, 4, 5 years, is that easy access to cheap money is going to disappear. So the ability to pick up the phone to the bank manager and go, I'm a bit short at the end of the month, can you cover the wages for 10 grand, is going to get harder. The ability to go and get cheap finance on the next bit of kit you want is going to get harder. So if you've got cash locked up in assets, that might be a financial risk for you when you need liquidity of funds to trade your business. Okay? So the problem we're seeing at the moment, and this is where I think your industry is getting it a bit harder than some, is that costs are rising rapidly. Customers are becoming more price sensitive, more price aware than they might have been in the past. Overheads, energy consumption, fuel bills, you know, you all see it day to day in your businesses. Wage costs, transportation, energy prices, everything is on an upward trajectory at the moment. Despite the chance of knocking 5p off a litre of fuel, I haven't seen that translate to the pumps where I am yet. So costs are on the increase. Profits are going to be under pressure for the foreseeable future. It is going to get tougher out there. Now, low profits or even losses, they're not the big problem in the short term. Most businesses can ride a tough month or a tough quarter or even a tough year or more. Continued loss making, continued underperformance eventually impacts on cash, the amount of money you've got, or perhaps the willingness of the bank to support it. When you're making profits, the bank might lend you the money. If you're demonstrating losses, they're not so keen to lend you money. So the big issue for all businesses, construction is as bad as any other at the moment, is cash flow. If customers start to be a bit slower or not at all, if your suppliers start to chase a bit harder or stretch, tighten up on their credit terms, and your bank or your other finance sources are a little bit less willing to fill in the gaps when you've got a bit of a glitch, then the risk of running out of cash becomes significantly greater. And I think we've all got spoiled for the last 5 or 10 years. We're actually getting money was cheap as chips, quite easy to get your hands on. That is not going to be the case in the next few years. Businesses don't fail because they lose money. They don't fail because there's no profit there in the short term. They fail because they run out of cash. Now, they run out of cash sometimes because they're constantly losing money. That's an inevitability about making losses. Eventually, that translates into cash flow. But actually, even businesses who on paper are profitable run out of cash because customers are paying a bit slower, suppliers are chasing a bit harder, and you haven't got enough up your sleeve for that rainy day. Now, that usually, from an accounting point of view, when do I see that? I see that when PAYE and VAT and corporation tax all coincide. That's the perfect storm of taxes, and suddenly that's an awful lot of money in a month where, oh, that customer hasn't paid us yet. So that's the problem we've got to manage from a financial risk point of view, is cash.